Welcome, everybody. I'm very excited for our retirement ready talks tonight. Hope you like that music. Wasn't sure if I was supposed to dance or what I was supposed to do there, but excited to be here tonight. We have a great topic for everybody. I think we've been hearing growing and growing concerns both on the radio show, clients, and folks that are calling in about, the potential for this rising tax rate environment. So I want to talk a little bit of tonight. We're going to keep it brief for you, but I want to talk a little bit about, what got us here from a tax perspective and a debt perspective for our country, what you might want to think about, and most importantly, what you want to do to help protect yourself from this rising tax rate environment that we're likely to be facing. We know taxes can be a big part, can eat a big chunk out of our retirement assets, whether it's when we're taking money out or passing money on to our loved ones. So it's something we
The
definitely want to
coronavirus.
address and think about. So a couple disclosures for you I'll throw up on the screen. We're going to talk about some taxes tonight. I'm not a CPA, I'm not an accountant, so please don't make any changes without talking to the appropriate professionals. We want to connect you with those and make sure you do everything properly. But let's take a quick look at the agenda tonight. We're going to talk about where we are right now, kind of how we got here, and most importantly, some action items that you can take to help kind of protect your retirement accounts and your future from this likely rising tax rate environment. So, big question I think that, or statement that we may have heard growing up, maybe mom, dad, grandma, grandpa, somebody said, put everything you can away into that retirement plan at work because when you retire, you're going to be in such a tiny tax bracket, you'll barely pay anything, right? Well, that's not always the case for all of us, right? That may be false. And for some of us, we end up in a larger tax bracket when we retire, especially if you consider this new tax bill that was passed under the previous administration, right? It provided a larger standard deduction, but for many of us, we lost the ability to itemize, so we can't even write off those charitable contributions, right? So for some of us, we're in a higher bracket. Or maybe you're listening today and you're in your 70s, you have Social Security, pension, IRS comes knocking, wants you to start taking a required minimum distribution. Now you could potentially be in a really high tax bracket. So it's something we really want to think about because we really have this silent partner, right? Many of you have saved really well in your 401k or retirement accounts, but that has a big old IOU stamp from the IRS. That's not all our money. So we really have to think about how we're going to manage that taxability in retirement. So let's take a quick look at how we got here, right? Of course, we've had all these federal stimulus packages, right? It's hard to think it's just been a year since the coronavirus pandemic started, but we had a very rapid drop in the market. The unemployment went sky high. So we had a federal stimulus package in March, followed by another package in January, followed by another package here recently. President Biden just talked about the new stimulus infrastructure spending plan, which is another trillions and trillions of dollars. And when we think about it from a debt perspective, it gets really expensive, right? And we have to think about that. The debt is growing and growing and growing. One of the things we look at when it comes to debt is a simple measure called debt to GDP ratio. Think about this simply. If in your household, your GDP, that's the gross domestic product of the country, that's just the country's ability to produce income. Think of it that way. So if you relate it to your household budget, that's your income versus your expenses. Well, you can see the big jump here from the first quarter of 2020 to the second quarter of 2020, and we don't even have the numbers here out yet on how this debt to GDP ratio has changed with the last two stimulus bills, much less any of the future ones. So we're stacking this debt up pretty tremendously. This is a quote from former Treasury Secretary Stephen Mnuchin, and Janet Yellen frankly would say the same thing, right? They tell us in different times we'll fix the deficit. We don't have to worry about the debt right now. Just don't worry, right? Well, my concern, working with folks that are in retirement or nearing retirement, is that what happens when the government decides we do need to worry about it? Right? And that's what we want to help you prepare for because that's what can really take a big bite out of your retirement. Second question is, where could we go from here from a tax perspective? Well, of course, we have a new administration. Don't put any weird emojis in the comment boxes, right? We're not going to make any political statements here tonight. But we have a new administration, new makeup of Congress, and that potentially means some rising taxes, right? We don't know what's going to happen yet, but if we look at President Biden's proposals, you can see on the chart there income tax brackets going up, capital gains going up dramatically, dividend taxes going up, estate taxes going up, the estate tax exemption dropping quite a bit, and a big one is what's called the step up in basis. That's a great provision in the tax code where your property or your stocks, when you pass away, your beneficiaries get to inherit them without any taxation. That's a huge advantage, and they're talking about taking that away. And remember, if we think to the former administration, President Trump, he got through a tax cut, but that was a temporary tax cut for us as individuals. So after 2025, rates automatically go back up to where they were, even if the new administration isn't able to get any new tax codes through, which probably isn't likely. So that begs the question, what can you do to protect yourself, right? Maybe I got everybody worried. That's not my intent. I just want to take an honest look at where we're at today. I think it's really, really important. You know, I can't, when I go through times like these, I think often about my grandparents, my mom's parents, Mary and Sam, and they were incredible, some of the most brilliant people I've ever met in my life. And Grandpa Sam was a World War II Navy vet. And after the Navy, he got a PhD in economics. And Grandma was brilliant. Back then, the professors would get a sabbatical every 7 years, so they get a paid year off. And he'd pack the family up, move to another country, and they'd, my grandma would learn a new language in weeks, and Grandpa would write a book about the economics in that area. So brilliant folks, but both children of the Depression, right? And that was so impactful to them that they never invested in anything but CDs, right? Think of what their money could have done had they had an appropriate plan over the many years of their lifetime and their retirement, right? So when it comes to taxes, it can sound scary, but you really want to implement a plan because there's lots of great ways to deal with this. And it doesn't have to be as complicated as a game of chess, just doesn't really need to be. So the first area I want you to look at tonight is what's called avoiding tax volatility, and we want some tax diversification. What do I mean by that? Well, generally speaking, there's three types of tax buckets that we can fall into. First one is what's called ordinary income, income that's taxable. Think about that as your pensions, right? Your 401ks, IRAs. We got a tax deduction when we put the money in. It got to grow tax deferred, but every dollar that comes out is taxed at a pretty high tax rate, that ordinary income tax bracket. The next column is what we call tax deferred, right? And think of this as our capital gains, long-term, short-term capital gains. For many of us, that rate today, as long as we hold an investment for over a year, is only 15%. So it's definitely a preferred tax rate. Can be higher based on your income, but most of us would fall in that 15% bracket. Then the last bucket, now this is my favorite one. Read those words on the screen. Tax-free. Boy, that's got a nice ring to it, doesn't it? Let's say that again. Tax-free. If you can't fall asleep at night, just recite that to yourself, and that'll get you right in the mood. But what we're talking about here is the Roths, right? These are Roth IRAs, Roth 401ks. We don't get the deduction when we put the money in, but it grows tax-free, comes out tax-free, passes on to your beneficiaries tax-free. So we get some really great benefits there. Problem is, not a lot of us have money in that bucket, right? So we want a nice diversified portfolio. Oftentimes we sit down with a family, we just simply add tax diversification, and that can add longevity to the portfolio. That means your money lasts longer, so you have less concerns about outliving your money, right? So action item number one is we want to offer you a complimentary tax diversification review. We'll take a look at your portfolio, see if we can maybe rearrange into some of those different buckets, see if we can get a little bit smarter about which accounts we're taking money out of in which order, so we can make sure your money lasts as long as possible. If you're interested in that, you can see at the bottom of the screen, you can text the word appointment to the phone number below, or you can visit us at the website. You can schedule an appointment at your convenience. That's completely complimentary, and we'll take care of this for you. And if you're learning some stuff tonight, I greatly appreciate it. If you're watching us on Facebook, if you can hit that like button, there's also a button there in the upper right corner where you can schedule an appointment directly through Facebook. Or if you're watching us on YouTube, if you hit that subscribe button, we'll let you know about future educational events, and we have lots of great videos uploaded for you on a variety of different topics. Next topic I want to cover, the second out of three, is we want to take advantage of these lower tax brackets. What do I mean by that? Well, we know taxes, regardless of whether the new administration raises taxes or not, taxes are going up after 2025, right? You can see on the screen here what used to be 12% is now 15%, what used to be 37% is 39%, and everything in between, right? So we know tax rates are going up. Here's an example. Dave and Sarah, they make $170,000 of income between the two of them. In 2017, before the most recent tax cut, they were in the 28% tax bracket. Last year, only 22%. But we know in 2026, if no new laws are passed, they're going back up to the 28% bracket. So I think rates, if you look at them historically, might be the lowest rates that you and I ever see. Very, very low income tax rates right now, so we want to take advantage of that. How do we do that? Well, we want to take those IRAs, 401ks, and convert them into those tax-free Roth IRAs, right? Now, the downside there is it's going to increase your tax bill this year. But I can make the argument, and we can show you the numbers, that we're better off paying these lower rates. I'm not suggesting you convert your whole IRA over in one lump sum. You get pushed into such a high tax bracket, it wouldn't make any sense. But we want a plan where we convert it piece by piece so we can take advantage of these lower tax brackets. Here's an example. This is Dave and Sarah. They decide they want to convert $100,000 of their IRA to their Roth IRA. If they did it back in 2017, right, it cost them about 33% or $33,000 in taxes. If they did that exact same conversion last year, it only, I say that somewhat tongue-in-cheek, but it only cost them 24% or $24,000 in taxes. That's a 25% savings. And remember, now that money's growing tax-free, coming out tax-free, and passing on tax-free, right? Remember, one of the things we lost in 2019 was the stretch IRA. Some of you may have an IRA that you inherited from mom or dad. You get to stretch the tax liability. You take a little bit out each year and you can keep it growing. That's now gone. Now your beneficiaries have to take it out over 10 years. If you have a large IRA or 401k, that could mean some substantial taxation, right? So some of you may be saying, well, I get it, Tony, about these Roths, but, you know, long term, I lose the money that I pay in taxes and that's not growing anymore. That's a fair point. So let's look at an example. Let's assume that you wanted to take your $500,000 IRA and convert it to a Roth. Now, I would never recommend you do that all in one fell swoop, unless it was part of a more complex tax strategy. But let's just take a look at it for a second. If you said, you know, I just don't want to pay the taxes. If you live to average life expectancy, the taxes on your required minimum distributions over the years are $210,000. Let's assume you reinvest that because you don't need it, right? Then we're going to have some taxes on those investments for a grand total of $419,000 of taxation over your lifetime in retirement. If we just simply bit the bullet, converted that $500,000 over, yes, we'd have a $125,000 tax bill, but then it grows tax-free, comes out tax-free, passes to your loved ones tax-free. I would say paying $125,000 is a much better deal than $419,000. Now, this isn't going to make sense for everybody. It depends on your income. We want to do an analysis and make sure it's appropriate for you. I know there's a lot of numbers on the screen, but it's also important that you do it appropriately. What we're looking at here is 3 different tax strategies. Column on the left was a couple we met back in 2019. They heard me talk about tax strategies, spoke to their accountant, and their accountant said, yes, you can do a $100,000 Roth conversion without going into the next tax bracket. And I analyzed it, we looked at it with our tools, and we said, yes, that's correct. And the difference there, if you look at the total tax in the upper left, they were already paying about $24,000 in taxation. If they went ahead and did this $100,000 Roth conversion, their tax bill went up to $49,000. Now again, a lot lower than it may be in the future, but that's still a pretty substantial increase in their tax bill. As we got to know each other a little bit better, they shared that they do a little bit of charitable giving, nothing substantial, but a little bit. So we layered in a charitable strategy, and you can see on the far right, they accomplished that $100,000 Roth conversion with only an additional $2,000 in taxes. That sounds a lot better to me than paying an additional $25,000 or more in taxes. So it's important that you do it the right way. Action item number 2 is we want to encourage you to get a complimentary asset conversion review. We're going to look at your dollars, show you what the tax bill would be, and see if it makes sense to implement this as part of your written retirement and income plan. Again, if you want to take us up on that, it's completely complimentary. You can text the word appointment to the number below or visit us at wealthwisconsin.com to schedule that appointment, and we'll take care of both of the tax diversification review for you and the asset conversion review. Now, the third and final action item I want to talk about tonight, I promised you I'd keep it brief. I don't know if any of you have ever built a house before, but I went through the process about 7 years ago, and this isn't my house, but I walked up one day and I saw something like this. Now, frankly, wasn't the most exciting part of the process, right? But arguably the most important, because it doesn't matter if I start to get cracks in my foundation, doesn't matter what pretty flooring or cabinets or fixtures I picked, right? It's all going to crumble. Well, the equivalent in your retirement plan to the foundation is income. The number one question we get from folks is, do I have enough money? Am I going to be okay? And whether they realize it or not, they're asking me about income. Do I have enough income to do all the things I want to do, right? And we've all heard the myths that you're only going to need 70 to 80% of your pre-retirement income. I think that's a bunch of nonsense. We tend to see people go through different phases. The first phase we call the go-go stage, right? Where most people, their income goes up. I mean, think about it. How many folks that are tuning in today want to spend 20% less the day you retire? Probably not many of us, right? In fact, most of us want to travel or do some of the things we dreamed about, so the budget goes up. Then we enter that second stage of life we call the slow go stage. Now this hurts, my back hurts, whatever it might be, I'm more comfortable at home, want to work on a hot rod in the garage or garden or whatever your passion is, right? So then the budget comes back down. And then of course in the no-go stage later in life, it shoots back up due to healthcare expenses. So we want a dynamic income plan. Here's a question I'll ask you. Unfortunately, I can't hear your answer, but I'll ask you a question. You can answer it to yourself. How many of you feel like you have a written retirement and income plan? Here's the caveat that you understand. A written retirement and income plan that you understand. If you're saying no right now, don't feel bad. That's what the majority of the groups I speak to say. They say, Tony, I don't have a written retirement and income plan that makes sense to me. And if this is what you're thinking about, that's not what I mean. I don't mean the stack of papers that mean nothing to any of us. Or I'm not talking about that once a year appointment you have with your financial advisor where he or she says a bunch of stuff that doesn't make sense to you. At least you get a nice coffee and a magnet with the brewer's schedule for the fridge, but it just doesn't make sense to you. That's not what I mean. I mean a simple written retirement and income plan where you know exactly where your income's coming from what accounts and what order, and you know exactly how long your money will last. In the years that I've been in business, we call our income plan the Retirement Ready Roadmap, and I found some commonalities with most families. Most families we work with want to have some comfort, some confidence, and some control of their plan, right? You want to know you're going to be able to survive the storms, the ups and downs of the markets, right? Correctionary periods, pandemics. You want to have some control. Things change in retirement. And I think there's 5 areas you really want to address in your plan. The first one is investments. And frankly, this is where most advisors start and end. Doesn't mean they're bad. You just have to understand who you're working with, right? Investments are important, but they're a part of the overall conversation. Within your investments, we need to take a look at your risk. How much risk are you comfortable taking? And most people have no idea how much risk they're actually taking. So it's something we really want to address for you. Next one is income, right? We want to know we have the income to do the things we need to do. We want to know how long is our income going to last. So we need an accurate income plan where we know exactly where our money is coming from and how long it'll last. Healthcare is such a growing concern. This is one of the reasons we have a independent health insurance agent. Whether you're looking to bridge the gap between retirement and Medicare age, or maybe you've hit Medicare age and you're making that tough decision. Do I do Medicare supplements, Medicare Advantage, Part D? We can help you walk through that. Or maybe you want to do some planning. God forbid someone winds up in a nursing home and you want to protect your spouse or your kids from losing all the assets to a nursing home. Very important part of a plan. Look, I understand these aren't fun things to talk about, but they're very manageable. There's different ways to deal with them depending on what your goals are, but we really do want to talk about it, right? And then it's family. I mean, most of the families that we work with are saying, Tony, if something happens to me, I want to make sure my spouse is going to be okay. And even more importantly, I want to make sure when the money passes on, Uncle Sam doesn't become one of the largest beneficiaries. This fifth area is the area we've really been talking about tonight. But it's really important that these all work together. Laws change, things change. This has to be a dynamic plan that continues to change as you do in retirement, right? And you don't want to be this guy. You don't want to be a crash test dummy in retirement, that's for sure. You want to have an accurate plan that makes sense to you. I love this quote from Warren Buffett. He says, it's insane to risk what you have for something you don't need. Insane to risk what you have for something you don't need. Right? And it makes me think of course, a bit of a sports fan. I love the Packers, and I have this vision, right, that our Aaron Rodgers comes back next year and takes us all the way to the Super Bowl, right? And we're sitting in the fourth quarter of the Super Bowl. There's 5 seconds left on the clock. We're on the opponent's 5-yard line, and we're already winning by a touchdown. Can you imagine a scenario where Aaron Rodgers takes that snap, tries to throw another touchdown to go up by 2 touchdowns? Of course he wouldn't, right? The risk would be overwhelming. It just wouldn't be a payoff. He's going to take a knee. He's already won the game. Well, I can't tell you how many families I've met over the many years we've worked with folks that are in retirement or nearing retirement that have already won the retirement income game. Yet they're taking risk in their portfolio where they could lose 30, 40, 50%. It's really important to align that risk. It makes a lot of sense to make sure you're going to be safe and okay. Action item number 3, we want to encourage you to connect with us and get a complimentary retirement-ready roadmap. That's a written retirement and income plan where we're going to address those 5 areas. Completely complimentary process with us. And again, to initiate that, you can simply text the word appointment to the number below, or you can visit us at wealthwisconsin.com to connect with us, and we'll get that process started for you, completely complimentary. Last quote of the night, and we'll get you wrapped up here. This is a great one from Will Rogers, He says, the difference between death and taxes is death doesn't get worse every time Congress meets. So that's certainly true, but look forward to talking to each and every one of you. I hope you learned something tonight. If you did, again, please give us a like on Facebook or hit that subscribe button on YouTube. We'd love to get you more educational content. Thank you so much for your time tonight.